Hi guys, this is Adam Khoo here, and I'm here to do a market update. It's the 21st of January. It's been some time since my last update, so I thought it's time to do one. So before I begin, let me do a quick review on my last three market updates, and where are we going from here. And if you take a look at my playlist on YouTube, you can watch all my previous videos. So on the 24th of December, I posted this video, which was how to play the market plunge. On the 26th of December, it was, hey, the market's rallying back. Is it a dead cat bounce? And on the 8th of January, I talked about how to buy great companies that are selling at huge discounts before they recover. So let's go back to that first video on the 24th of December over here. So if you have not watched that video, please watch the video. It's important to understand the sequence of events. So at that time, the S&P 500 had plunged really massively, right? We had this 90-degree plunge, and I created a video to tell people that, hey, while most people are panicking and selling, you should be buying the market. You should not panic. Now's the time to buy. And the reason I knew people be selling out there is because they'd be reading a lot of news. And let me recap what happened. In fact, I've got some slides over here, and you can see that on the 23rd of December, this was on CNBC. They said, latest charts declare bear market. Suggest correction will last another 6 months. So let me ask you a question. Imagine you're a guy who's just a normal investor, and you read this piece of news that said, hey, on the 23rd of December, they're telling me that the bear market started and we're going down another 6 months. What are you going to do? That's right. You're going to call your broker on Monday and say, sell, right? So that was on the 23rd of December. And on the 24th of December, the next day, they had another headline that said, the worst is yet to come. Experts say a global bear market is just getting started. Holy shit. You call your broker, sell, right? And you would have sold on the 24th of December when the market opened on Monday. And guess what? That would have been the worst time to sell. Because if you had sold, let's look at what happened, right? So the 24th of December was here, right at the bottom. If you had sold there at 2362, you'd have sold right at the bottom of that plunge. And within just a few weeks, or rather 2 weeks, the market has gone up to 2670. That is, my friends, a 13% gain in the market, and you would have missed that if you had sold over there. So that's why most retail investors lose money in the markets, because they make decisions based on reading the news. And I can guarantee you, when you read the news and you make decisions based on the news, you will always lose money. That's my experience over the years. So imagine you're an investor and you were kind of like investing in the markets, right? And say you bought over here, for example, you bought over here, and the market's going up, and you're pretty happy making money, and suddenly you have got this plunge, right? So from there to there, you're down kind of like 20%. And at that point, you read the news, and they tell you, hey, bear market is going to get worse yet to come. You say, okay, call your broker, sell. And the moment you sell, guess what? You would have missed the market going up 14%. 13%, yeah, 13%. And say, shit, right? So from my experience, I realized that every time the news tells you, something bad, that's the time to buy. And the news tells you something good, that's the time to sell. You always go opposite of what the news tells you. Now, why? It's not because they're out to screw you. It's not because it's fake news, right? It's not fake. It's real news. But the reason is because when you read the news, it is always late. To make money in the stock market, you must always base on decisions based on price action, based on what's happening right now on the price action. Because only when the price moves, the news would follow later, which is too late. And that's why I created a video. I did, and I say, hey, that's the time to buy, not to sell. So how did I know that it was time to buy? Right? It's not because I can predict the future. I'm not a fortune teller. But it's because of experience of trading the markets now for 28 years. And here's the thing, when a market drops, okay, it will always bottom eventually. Every market crash will bottom. The question is, when will the market bottom? The market bottoms when there are no more sellers left. Does it make sense? Because if there are no more sellers left, it can't go lower, right? Now question, when are there no more sellers left? There are no more sellers left when the last few retail investors holding the stock have panicked and sold. In other words, the market can only bottom when the last seller has sold. The market can only bottom at the point of maximum pessimism, at a point of maximum panic. So when do people panic? People panic when they see a plunge in the market, and I call it a parabolic plunge. So you can see historically, every time there's a 90-degree plunge in the markets, and you have got kind of like 8 to 10 red candles in a row, bearish candles in a row, that signals the bottom of the market, at least temporarily, right? So let me show you an example of what I mean. So again, currently, what do we have? At this point, we had this 90-degree plunge. And if you count, you've got more than 10 candles in a row. This creates panic selling. People go, oh my God, they call it a sell, get me out, right? So when everyone panics and sold, the market bottoms and it starts the new rally up there. Now, very often, the market doesn't just rally in a V-shaped fashion. Okay, oftentimes what happens is after a 90-degree plunge, the market will rally, right, and then it will come back down for a second plunge. We call it a forced double bottom. And those who kind of like were smart to enter there and they did not know how to take profits, if they place their stop losses over there, guess what's going to happen? The market makers, the institutions will force the market down, hit their stop losses, force them to sell, and then the market will stage its real rally up. Okay, so very often we have got this 1, 2, a double bottom pattern before the market flies. Once in a while we get a V-shaped bottom. Okay, so I suspect right now we could be seeing a V-shaped bottom, but not just yet. I'll talk about it in a while. But my point being, every time you see a 90-degree plunge where you've got, 8 to 10 red candles in a row, that's not when you sell, that's when you buy. Okay. Now the reverse is true. When you see the market going up and you see 9 to 10 bullish candles in a row going up 90 degrees, when people are saying it's great, that's the time you get the hell out. Okay, you always do the opposite of what everyone else is doing. That's how you make money. So if you go back historically, let's go back historically to the recent bear markets and let's see what happened, right? So I'm going to put in some of my charts. Give me a second so I can identify some of the recent downtrends. Okay, there we go. Okay, so if I scroll back, again, take a look at this. So this was a mini bear market. And again, when did it bottom? It bottomed during a, there you go, 90-degree plunge. This creates panic. Oh my God, right? Oh, no. And that's when you get in, right? And that's what Buffett says, be greedy when others are fearful and be fearful when others are greedy. There's another guy, some rich dude who said, buy when there's blood on the streets. And when you see red candles is blood, and that's when you buy, right? So again, notice this was a typical forced double bottom, right? So it made a low, it went up, and boom, and it went all the way up. All right, so you've got a 90-degree plunge, a slight dead cat bounce, second 90-degree plunge, it goes. Same thing over there. Look at that. That's a 90-degree plunge that creates panic selling, goes up, forces it, goes up all the way up again. Let's go back to there we go. Although this was not a bear market, this was just a normal correction, but again, take a look at this 90-degree plunge, panic selling, it reverses up. So look for 90-degree plunges to know the market's bottoming. Okay, let's go back some more. Here's an example, right? So again, 90-degree plunge. Can you see that? Panic selling makes a low. We call that a dead cat rally. And then plunges again, killing those who put a stop losses, and the market flies up. All right, so we call that a forced double bottom. But once in a while, we will have a V-shaped recovery, which is rare, but it could happen, V-shaped recoveries, right? Look again, this is another one, right? 90-degree plunge, you can see 10 red candles in a row, boom, goes up. So this was more like a V-shaped thingy, right? So question right now is, okay, so are we going through a V-shaped bounce, which means one time and we're going to fly all the way, or are we going to go for a double bottom? Remains to be seen. I'll talk about it more towards the end of this video. So for now, I just want you to understand the concept of why I called a buy. All right. I can't read the future, but it's based on probability, based on experience in the markets. When you see a 90-degree plunge, that's when you want to look for buying. All right, especially after a double bottom. Now, some people ask me, do you look at kind of like indicators? Well, not really. You can if you want to. If you put in what we call oscillators, like stochastics and Bollinger Bands, it can help you to read oversold conditions. When the market is like a rubber band, it's been stretched too much, it's gonna snap back. All right. So, for example, if you put in something like this, where did I put it now? There we go, full stochastics. So people who are more, well, I wouldn't say amateurs, but if you're not so experienced, you can use indicators to help you, right? And you can see over here, after this 90-degree plunge, the stochastics is oversold, right? So when it's below 20, it's kind of like the rubber band is, stretched, it's going to snap. And the price is outside of the Bollinger Bands that acts as kind of like two bands, right? So when it goes above the band, it snaps back. Below the band, it snaps up, right? So when you see it's outside the band and it's oversold, high chance it's going to snap back up. Boom, back to the band. We call that mean reversion. But personally, for me, I don't use these indicators because from experience, when I look at a price action, I kind of know where it's going. Alright, so let's get rid of these studies. We don't need that. And let's go back to my YouTube videos. Alright, so that was my first video, which was entitled "Don't Get Effed by the Markets." Don't get screwed by the markets. Okay, and then on the 26th of December, I created another video because I saw, hey, I was pretty accurate on that. Give me a second. I was pretty accurate on that call. So we did have that rally going up, okay? So at the point of time, I said, okay, is this a dead cat bounce? In other words, is it going to go up? It's like a dead cat bouncing, and then it's going to continue going all the way down to continue the bear market, or is it going to reverse into a new uptrend? So my second video addressed that, and what I said was this, and let me just recap what I said. I said, it depends, right? First of all, when the market rallies back, there are resistance levels. If it can break the resistance levels, it could be a new bull run. And I said in the video, I don't expect this to be a bear market that leads to a recession. This is not a recessionary bear market because economic fundamentals are still really strong. I expect this to be a baby bear market. And a normal bear market lasts anywhere from 3 to 6 months, which means it's been October, so yeah, another 1 or 2 months, that's it, right? And a normal bear market usually would have a 20 to 30% fall in price. So far, the market has fallen 20% and we've recovered about 13%. So this could potentially be the end of this baby bear market and a great time to have bought stocks riding the wave up. And I'll talk about that in a short while. Now, so where are the resistance levels? So the first thing is to look at Fibonacci, which I did if you watched the video. And I said, okay, if you use Fibonacci, give me a second. Where would you place your levels? Okay. So do note that we are on a short-term uptrend right now with this rally, but we're still on a medium-term downtrend. So until the S&P can cross above the 200 moving average and the 200 slopes up, or until the 50 moving average crosses above the 150 moving average, that confirms a new bull market. We are not there yet. The new bull market is not confirmed. Right now, it's still neither here nor there. All right. So again, I'm going to use my Fibonacci tool. Right. So this was the start of the impulsive wave down. So we're gonna drag it to the end of the impulsive wave. There we go. At the same time, there is a strong level of resistance over here. You can see this was a support, broke, became resistance, became resistance, became resistance. So there's a strong level of resistance at 2800. That's a level of resistance that the market has to overcome. Okay. Now, over here you have a level of resistance as well at 2.6 and another level at 2.8. All right. So I mentioned in my previous video that if the market rallies, okay, and it hits this 50 moving average, if it cannot break the 50 moving average, if it finds resistance at the 50 that coincides with the 61.8% Fibonacci level, that coincides with this support resistance level, it's going to go all the way back down again. But what has happened is the market managed to break through that level. It has broken above this resistance level. So that is a bullish sign. Now, some people post really interesting comments on my videos and they say, oh, you were wrong, you said it's going to go down. I didn't say it's going to go down. I said it could potentially face resistance, right? And some people say, you know what, Adam, you were spot on in calling that bottom, and this time, you were a bit off. Now, first of all, remember something. No one can predict where the market's going. Not me, not Warren Buffett, not George Soros, okay? We're not fortune tellers. To be a successful investor and trader, you do not predict the future. You do not predict the market, right? If you attempt to predict the market, you're not a trader or investor. You are a gambler. And if you're a gambler, sometimes you can make money. Eventually, you're going to lose everything because you're not having the right psychology, the right mindset. The right psychology is understanding that when we study fundamental and technical analysis, we're not doing it to predict the future. We're doing it to find what's the high probability outcome. In other words, what's more likely to happen? Is it guaranteed to happen? Of course not. What's more probable? And if you follow the rules of high probability, you can only hope to be right slightly more than half the time. Okay, so you can't be right all the time. But as long as you're right half the time or more than half the time, you can make money consistently. As long as you manage your risk. It's all about risk management. So when you're wrong, you lose little. When you're right, you win more. So as long as you win more than you lose, you're making money. So that's the point of it, right? But let me go back to psychology a while later. All I want to say here is this. So as the market was going up and we approached this resistance level, right? Would you have shorted the market here? Now, did I short the market? No, I didn't. Why? I didn't have confirmation. Remember, as a trader, you never ever trade based on prediction. You trade based on confirmation. Always wait for the price action to confirm your thesis, to confirm your expectation. So when it reached that level, I wanted to see a bearish candlestick pattern, like a bearish engulfing pattern, a bearish pin bar, and to start seeing bearish candles before I started shorting. I did not see that. In fact, all I saw bullish candles all the way. So I didn't go short, right? So when the market doesn't confirm your thesis, do not follow your thesis. So right now, where are we? We have broken above this level. We're really bullish, but you know what scares me? We're going up right now in a straight line. So if you have not bought yet, now is not the time to get in. You know why? Because remember, markets move in waves. Doesn't go down in a straight line, doesn't go up in a straight line. So don't expect it to go up all the way up, right? After going up, it's gotta retrace and then go up again, right? It's like a breathing pattern. So at this point of time, I would say the market has gone up too strongly. So I expect it to retrace slightly, right? To come back down a bit, right? Now, here's the thing. In the next few days, watch this. If the market retraces and is able to hold above the 2,600 level, right? Because remember, support becomes resistance. Resistance becomes support, right? So if it retraces and bounces off this level, that's bullish. We're likely to go continue going up. Now, the next level of resistance will be 2800, right? So if it hits this, there's a resistance here. If it can't break this, if it can't break and we see bearish confirmation like bearish candles, then we are likely going to go down to retest the bottom. And then I'm going to start going short again and buy good companies at the bottom again, right? But if we can break that level, hallelujah, we could be continuing the bull market for a couple more years. So again, we can't predict the future, but we follow the market as it unfolds, right? So that's the whole point of it. So So as you watch my videos and you begin to learn how I use technical analysis and fundamental analysis to make decisions on entry and exit, remember that the right strategy is only 10% of your success as a trader. To make money consistently is not just about the technical or fundamental strategy. And that's why most people, they read books, they attend seminars learning all this, technical analysis, and they still lose money because they don't realize that it only makes up 10% of your profits, of your profitability, right? 30% comes from managing your money, position sizing, to ensure every time you put on a trade, you're risking a small percentage of your capital and you are risking the same percentage consistently. And to have the right psychology that in any trade you take, you can't be right all the time. So when it goes against you, you got to cut your losses. You have to cut your loss to only lose 1% or 2% at the very most. And when you are right, to not take profits too quickly, to let your profits run. So a winning trade, you will make double or triple or quadruple your losing trade. And that's the whole point about it, right? So remember to combine strategy with psychology and position sizing. So, give an example, right? So if you do, for example, 10 trades in a month and you follow the rules, right? And even if you get 5 winning trades and 5 losing trades, right? It doesn't matter, you're still profitable because every time you have a losing trade, let's imagine you risk 1%. So you're down 5%, for example, being really conservative here. And every time you've got a winning trade, you win double of what you lose, right? By placing your profit target double the distance from your stop loss, for example, or sometimes even triple, right? And you're making 10%. So 10% minus 5% is a 5% gain in a month of trading. And again, this is assuming you just risk 1% and you just take 10 trades. In reality, among my traders, we do up to 15, 20, 30 trades a month, both in the stock markets and in the currency forex markets. And some of us risk up to 2 to 3%. That's how we generate consistent income for ourselves. All right, I can tell you that you can make consistent income for yourself even if you're right half the time. Even if you're right 40% of the time, you can still make money, although a bit less, right? And there are some months when I'm right 70 to 80% of the time, you make tremendous amount of money, right? So again, it's not about making predictions, it's about probability and having a trading plan. All right, so let's go back to my last video on the 8th of January, which was how to get rich in stocks by being greedy when others are fearful. If you have not watched it, go watch my video, right?
Professional and impressive artwork from scratch that will blow people's minds.
Publicity, because there we go. All right, so this was my video where I said, hey, you know what, this bear market is giving us great opportunities as an investor to buy great companies at huge discounts. There are some really good companies out there that will definitely grow in value over time. It's going to make you a lot of money, and they were expensive, but because of some temporary bad news and because of the sell-off, it's given us an opportunity to buy these companies at discounts to their intrinsic value. And I talked about some more examples. I talked about Facebook especially and Tencent. All right, so I like to kind of like follow up on what's happening to these two companies, which I started buying in. So like I mentioned in my last video, one of the ways I've made a tremendous amount of money over the last 28 years in the markets is to buy great businesses in times of crisis at the right time, because no matter how good a company is, it will go through bad times, either a bear market or some bad news, and it allows you to buy when the price is really undervalued. And I talked about a couple of companies right now that are really cheap that are great to start looking at. JP Morgan in the banking sector, you've got BlackRock in asset management, you've got Federal Express, and I said don't touch GE because General Electric earnings are falling, revenue is falling, and so don't buy a lousy company. Buy a company that's great, sales are rising, profits are rising, great economics is just down for psychological reasons. And two of the stocks that I mentioned that were really undervalued were technology stocks, and one of them was Facebook, and the other one was Tencent. So Tencent is one of the largest tech companies in the world. It is one of the largest tech companies in China as well. So as you know, in China, they don't really use Google, they don't use WhatsApp, they don't use Facebook, they don't have Uber. So Tencent, they own WeChat, and WeChat is basically Uber, Facebook, Twitter, WhatsApp, Amazon, all rolled into one. So it's a fantastic business, right? So those of you who have taken my value momentum investing course online, you know that you only do this for very good businesses, and you have to ensure the company meets all these 5 criteria, right? Consistent growth, growth catalyst in the future, sustainable competitive advantage, high return on equity, and very low conservative debt. So in my online course, I teach my students how to look for companies that fit these criteria. So once it's a good business, you have to look at the price. The trouble is many people buy the right business at the wrong price, and it's hard to make money when you do that. So you only want to buy when the price is selling at or below the intrinsic value of the company. And there's a way to value the business using intrinsic value calculators that you get as part of my school, of my training, right? And finally, you want to enter when the price is showing a bullish uptrend pattern. Remember, on a downtrend, no matter how good a company is, if it's cheap can get cheaper, low can get lower on a downtrend. Always wait for a reversal of trend to enter. So it's about knowing what to buy and when to buy, and of course eventually when to sell. So I highlighted Facebook. Facebook is a great business. It just has temporary problems because of its data scandal, and it's solving those problems. But the great news is revenue is rising, profits are rising, its brand is still intact, and it's still growing its daily active users. And because of the bad news, the stock was down 45%. And it's really undervalued, right? So again, this was all the bad news it faced, and now the bad news is kind of like over, and the company's recovering. The intrinsic value for Facebook, as I calculated, was about $207. And at the time, Facebook was selling at $140. So it was really at a great discount. So again, I talked about looking at Facebook and entering once the trend began to reverse. So let's take a look at Facebook in a short while. The second stock that I talked about, which I'm really excited about, and I have to have a disclaimer, I've got big positions in these companies, right? So I'm not recommending you to buy, I'm just telling you my thought process on why I made these investments. So please don't take this as recommendations. I'm just sharing this, for educational purposes. So again, Tencent, like I mentioned, is a great business. It was down 47% because of temporary bad news. By the way, Tencent is the world's biggest owner of online games. Okay, and recently, because China had regulations to stop kids from playing too much games, and they banned some of these games, this bad news caused the price to drop 47%. But again, these are temporary problems that have been resolved. So as a result, great company, buy at a discount, and you make a lot of money once it recovers. So again, these were all the bad news that put the stock in. And again, Tencent, if you calculate the intrinsic value, this is using my calculator, it's worth $311. Now this is in renminbi or Chinese yen. So if you convert it to Hong Kong dollars, it's about 360 Hong Kong dollars. That's the intrinsic value. And at the time, it was selling at 250 Hong Kong dollars. So it's really undervalued. So I started accumulating positions in these companies. And let me just show you kind of like where they are right now. So let's look at Tencent. All right, so this is Tencent. By the way, you can buy the stock in the Hong Kong markets through any international broker like Interactive Brokers, or you could buy the one listed in the US under the ticker symbol TCEHY. So again, it's not a recommendation for you to buy. It's just, I'm just sharing for educational purposes and tell you, you know, that's what I did basically, right? So as you can see, Tencent is on the Hong Kong markets, right? And it was on a high of 480. And it went on this downtrend all the way to 250. So again, the intrinsic value, it's about 360, somewhere over there. But that is of my last valuation. Remember, companies increase in value as their revenues rise. So as I revalue the stock will be worth more and more over time. So when did I start getting into this stock again? Right, basically when I saw the change in trend. So notice over here we have got a downtrend pattern. Right, the price is making lower highs and lower lows. So again, you never want to enter on a downtrend because, you know, never go against the trend. Wait for the trend to reverse. So when did the trend reverse? Over here. You can see the trend reverse there as the price made higher highs and higher lows. And as you can see, the 20 exponential moving average crossing above the 40 EMA is a confirmation of the short-term uptrend. So over there was when I began to accumulate a lot more shares, and I anticipate it's going to go all the way back to about $400, $500. So you're going to make a lot of money on this one. Okay. Now again, like I mentioned, when I use fundamental analysis and technical analysis, it is only 10% of my success. It's all about money management and psychology, right? So as an investor, once you know it's a great company, what you do, you don't invest everything at one go. Now, for example, if I've got 10 grand, I've got more than that, but let's say I've got 10 grand, right? And I say, hey, it's reversing into an uptrend, for example. The moment I see an uptrend pattern, do I buy 10 grand worth? Do I put all my money in? No, I don't. I will do what is known as dollar cost averaging, which means I'll buy in stages. Okay, because I know that, you know, I'm not always right. Okay, so for example, if I were to buy here, for example, you know, and I say out of 10 grand, I spend 2.5k. You know, I invest a quarter of my capital, right? And let's imagine, you know, it went up and then boom, it went back lower again, which can happen. Sometimes you get false reversals, right? So what do you do as an investor? You just hold it because you know it's a good company. As an investor, you don't have a stop loss. Stop losses are for short-term trading, which I do as well in a separate portfolio, right? So as it goes down, for example, I won't add more because on a downtrend. And when it reverses into an uptrend again, what do? That's right, I'll start to invest some more, maybe on a 2.5k, right? So I'll average down until eventually it hits the bottom, okay? Now again, you can't always catch the bottom. You can't always buy at the bottom. No one's that lucky. So as long as you average down and your average price is near the bottom, that's enough. You're going to make a lot of money as it goes up. Does it make sense? Right? And if this happens to be the real bottom, which I suspect it is, and it keeps going up, I'm going to add on as it goes up as well. Right? So I'm going to average my way into the investment. Now, if you're approaching it from a trading perspective, so in trading, it's a bit different from investing. In trading, it's a short-term approach. You're in and out really fast. So in trading, what you do, sure, you could take an entry as a trader over here. You could buy somewhere over there, and you could put a stop loss below the low of the pattern, right? And again, you could risk 2% or 1% of your capital, for example. And if it happens to fail and it goes down, hits your stop loss, get out. Take your loss like a man, right? So if it's a losing trade, what happens? You lose 1 R. R represents your risk as a trader. So you lose, for example, 2%. That's it. Get out, right? And say it keeps going down. Wait for the next uptrend pattern, right? So the next time it reverses into an uptrend again, what do? That's right, go in again, risk another 2%. Say the next one's another loss, boom, you lose again, right? So you're down another 1R. That's fine. You're down another 2%. Keeps going down again, right? And eventually, the next reversal is the one that bottoms, and it goes all the way up, and you hold it for a huge profit run of, I don't know, 10% or 30%. Right? So I can tell you that in trading, even if you are right 1 out of 3 times, so let's imagine you were wrong the first time, you're wrong the second time, but the third time you were right, guess what? You're still making money. Because when you're wrong, you cut your losses quickly. So you lose a little. When you make, boom, you make a lot. That's the trading approach. So I've got both an investing course and a trading course. So in investing, we focus on the long term. Good companies we hold over time. In trading, it's purely based on technical analysis, right? We're in and out really quickly to make quick profits, and we just aim to be positive by making more wins than losses. That's it, right? So that's Tencent, and for Tencent, I'm actually going in more as an investor, right? Just to share that with you. And you can also buy the one in the US market, or not. You can buy. I'm just saying, one can buy. Be careful not to give advice. So it's TCHY, and you can see again, there's my analysis over there. There we go. So you can see again a very clear downtrend pattern in the stock over there, and reversing the trend. So on the US markets, it is selling at $43 US, right? It's in US dollars, right? Now, let me very quickly talk about Facebook, because Facebook is one which, again, is a great company, selling at a discount. And if you take a look at a chart, what's happening right now? Okay, so you can see over here, Facebook was at a high of 220. And it went on this big downtrend because of all the bad news. Okay, so as long as it's on a downtrend, you don't touch the stock because it keeps trending down. So you never know where's the bottom now. This is the possible bottom because of the 90-degree plunge, panic selling. We've got a double bottom false, right, which I mentioned. And now the price has broken above the downtrend line. And it's also above the 50 moving average, which is a really bullish sign. As you can see as well, the 20 EMA has crossed above the 40 EMA, which is a confirmed short-term uptrend, right? So right now we've got boom, boom, boom right there. Okay, so if you're not in yet, or rather if a trader's not in yet, you could wait for it to do a bit of a retracement, right? And then you get in for the ride all the way back up to eventually $200, $300, and I'll bet my bottom dollar in the future is going to be worth $300, $400, $500. Why? Because I know it's a great company, it's going to rise. So just a temporary retracement. So essentially, that's how I analyze the markets, I analyze companies. Now, the final thing I like to talk about is following up on a video I made a couple of months ago. And I can't remember when I made it. I think it was a couple of months ago. Let me just check it out. When did I make this video? It was quite some time ago. It was on China. There we are. Profit from the China stock market trade war. So again, go watch that video. If you want to make a lot of money and profit from the markets, go watch this video. All right, I'm going to follow up with that. And here's the interesting thing, right? China is going to be the world's biggest economy, and it's going to eventually overtake the US as the world's biggest market and stock market. And it's just at the beginning. See, the US stock market has been around for 224 years. China has only been around for 28 years in terms of its stock market, from a communist country opening up to become a capitalistic market in the last 29 years. So it's just at the beginning of a great run in China. Now, if you've been reading the news, you'd have read this, right? This was on the 28th of December, a couple of weeks ago. And what did Bloomberg say, right? China has the world's worst stock market, right? It had the biggest crash in a decade, and it lost $2.4 trillion. Again, this was on the 28th of December. And just yesterday, we had another news on Market Watch that said China posts its slowest economic growth since 1990. In other words, what all this news is saying is that China's market sucks big time. It's terrible. And again, most investors who read this, what will they do? You got it. They'll call their broker and say, you know what, get me out, or I'm not going to buy. And what did I tell you earlier on, guys? If you want to make money, you buy when you see bad news. You get greedy when people are fearful. Because when you understand the market, and again, the 20th of December, they said China had a worse stock market. But let's take a look at the charts. Now, you can actually use the GXC, which is an ETF listed in the US that tracks the China market, right? So you can see, sure enough, China is on a downtrend because of the trade war. And on the 28th of December, when the news article came out, when was that? 28th of December. Right here. Right at this point. Okay? So again, the bad news came out, and what should you have done? If you're smart, you'd buy. Again, notice the 90-degree plunge. The first plunge, the dead cat bounce, and a forced double bottom. This signals a potential bottom in the Chinese market. And we're now breaking above the 50 moving average, and this could well be the start of a new bull run in Chinese stocks. Now again, I could be wrong. If I'm wrong, no worries, right? Because I started buying in stages. If it drops some more, just buy some more, right? If I'm trading, it stops me out, I'll just wait for the next entry. But this could be the entry. And if you take a look at it from a macro perspective, let me just show this to you. There we go. Now, this is the 24-year price pattern of the China market, right? Shanghai Composite Index. And take a look. When the market started over here, it dropped. It dropped 61%. After the 61% plunge, it went up 300%. After it dropped 32%, it went up 112%. Dropped 56%, went up 500%. It dropped 73%, went up 206%. And right now, we're down 51% from the recent peak over there. So statistically, if you look at the history of any market, you've got bear markets and bull markets. Bear markets don't last forever. After every bear market, you're going to have the next bull market. And you make a lot of money when you enter at the beginning of the bull market or near the end of the bear market. Now again, no one knows exactly where's the bottom, but you can take an educated guess. If you take a look at the last 24 years, the biggest drop in China stocks was 73% and 60% and 50%. Okay, so we're down 51% right here. So let's imagine statistically, if you buy here, how much more can it drop? Maybe another 20%, right? To give you a 70%. So if it drops another 20%, that's fine. Okay, so you could buy a bit more at the bottom, but I can bet you my last dollar that after this, we're going to see the next bull run of 200 to 500% return. So that's how I make my money in the last 28 years and how I continue to make my money by understanding the statistics of the markets. Hey, if you like this video, click the subscribe button to be the first to be informed of new videos coming out. And if you want to find out about my online professional trading and investing courses, go on to piranhaprofits.com. Or for my live training courses in Asia, go on to wealthacademyglobal.com.